The credit score industry doesn't want you to know this. A perfect 850 FICO score requires you to carry debt, not pay it off, carry it. The system that's supposed to measure your financial health actually punishes you for being completely debt-free. And there's one specific number inside your credit score right now that is costing the average American between $100,000 and $300,000 over their lifetime. Most people optimize for the wrong number their entire lives. And here's the part nobody talks about. The company that invented the FICO score makes money every time a lender pulls your report. They don't make money when you pay cash. They don't make money when you're debt-free. In the next 10 minutes, I'm going to show you exactly what the credit score lie is, what it's actually costing you, and the 3 moves that let you win the game without playing by their rules. You probably check your credit score regularly. Maybe on Credit Karma, maybe through your bank app. You watch it go up, watch it go down. You make decisions based on it. Should I open this card? Will it hurt my score? Should I pay off this loan? What will that do to my score? You've been optimizing for a number without ever being told what the number actually measures. Here's the truth nobody explains. Your FICO score doesn't measure wealth. It doesn't measure financial health. It measures one thing only: how likely you are to pay back borrowed money. That's it. According to a 2025 Consumer Financial Bureau report, 34% of Americans with credit scores above 750 have less than $1,000 in savings. A 750 FICO score, under $1,000 saved. Those are not contradictory. That's exactly how the system was designed to work. Your score rewards borrowing behavior, not wealth-building behavior. And until you understand the difference, you'll keep optimizing for the wrong thing. And here's the part that's going to make you actually angry. That number I mentioned, the one costing Americans between $100,000 and $300,000. It's not your credit score itself. It's the interest you pay over a lifetime because your credit score was designed to keep you in a perpetual borrowing loop. And here's the third thing nobody says out loud. The 5 factors that make up your FICO score were chosen specifically because they predict lending profit, not your financial success. I'll show you all 5 and what they actually mean in about 3 minutes. But first, you need to understand the company that built this system. Yes, credit scores affect your mortgage rate, your car loan rate, sometimes your rent. But here's the math most people never run. 2 people, same income, $60,000 a year. Same age, 28. Person A spends their 20s obsessing over credit score, carries credit card balances to keep utilization healthy, opens new cards to improve credit mix, pays 22% APR credit card interest consistently. By 40, they've paid over $60,000 in credit card interest alone. Person B ignores the score optimization game, pays cash, invests the difference, puts that same $600 a month into an S&P 500 index fund. By 40, they have $127,000 invested. Same income, same 12 years. One optimized for a score, one built actual wealth. The score is a tool. It was never supposed to be a goal. And in about 4 minutes, I'm going to show you the one factor inside the FICO formula that nobody in Finance YouTube will actually name. The 5 FICO factors, what they actually measure. Your FICO score is made of 5 factors. Here's what they are and what they're actually measuring. Factor 1, payment history, 35%. Payment history is 35% of your score. This one is legitimate. Pay your bills on time. Don't miss payments. One missed payment can drop your score by 90 to 110 points, and that drop stays on your report for 7 years. A single missed payment in 2024 affects your mortgage rate in 2031. The fix? Set up autopay for every bill you have. Go to your bank's website today. Automate every minimum payment. You never miss, your score never drops. Takes 20 minutes. Payment history is the one factor that's completely in your control and completely worth optimizing. Factor 2. Credit utilization, 30%. Credit utilization is 30% of your score. This is the ratio of how much credit you're using versus how much credit you have available. The myth you've been sold is keep utilization below 30%. The actual truth is below 10% is where the real score boost happens. And here's what nobody tells you about this factor. It's measured at a specific point in time, usually your statement closing date. That means you can have a $0 balance on payday and still show 30% utilization to the credit bureaus because your charges from the previous month were captured before you paid. The fix isn't to spend less, it's to pay before your statement closes. The fix: find your statement closing date on each card. Pay your balance down before that date, not after. This one timing change can move your utilization from 30% to under 5% without changing your spending at all. Factor 3. Length of credit history, 15%. Length of credit history is 15% of your score. The older your accounts, the better your score. Here's the lie you've been told about this factor. Close old accounts you don't use. That is one of the worst things you can do to your credit score. Closing an old account shortens your average credit history. Your score can drop 20 to 40 points from one closed account. The fix: keep your oldest credit card open forever, even if you never use it, even if the limit is $500. Put one small subscription on it. Pay it automatically. Never close it. The age of that account is doing silent, free work for your score every single month. Factor 4. Credit mix, 10%. Credit mix is 10% of your score. This is where the lie gets most obvious. FICO rewards you for having multiple types of debt. Credit cards, car loans, mortgage, student loans. The system literally gives you a higher score for carrying more types of debt, all being paid monthly. Think about what that means for a second. A person with zero debt of any kind has a lower score than a person with 4 types of debt, all being paid monthly. The financially healthier person scores lower. This factor exists entirely because lenders want to see that you're comfortable managing multiple debt obligations simultaneously. It benefits them, not you. The fix: don't take on debt just to improve this factor. 10% of your score is not worth a car loan you don't need. Focus on the other 90%. This factor takes care of itself over time. Stay with me. Factor 5 is the one that's going to change how you think about your entire credit strategy permanently. Factor 5. New credit inquiries, 10%. New credit inquiries are 10% of your score. Every time you apply for new credit, a lender pulls your report, called a hard inquiry. Hard inquiries drop your score by 5 to 10 points each, and they stay on your report for 2 years. But here's what most people don't know. Multiple inquiries of the same type, like mortgage shopping, count as one inquiry if done within a 45-day window. The credit bureaus know you're rate shopping, so they give you a grace period. The fix: when shopping for a mortgage or car loan, do all your applications within 45 days. Multiple lenders, one inquiry impact. This is how you get the best rate without destroying your score. Here's what nobody tells you about your credit score. The highest possible credit score is not achievable if you're completely debt-free. FICO's own research confirms that people with 850 scores carry small amounts of revolving credit card debt, not because debt helps you financially, because the algorithm needs evidence of ongoing borrowing behavior. A person with zero debt, zero credit cards, zero loans cannot achieve a perfect FICO score. The system literally cannot score someone who doesn't borrow. Here's the exact statement from Fair Isaac Corporation's own published research. Consumers with the highest FICO scores tend to have several active credit accounts, low but non-zero balances, and a long history of on-time payments. Non-zero balances, on purpose. The perfect financial health score requires you to owe money. That's not a bug, that's the product. This week, 3 things, right now, not later. Number 1, set up autopay for every bill today. Go to your bank's online portal or each creditor's website. Automate every minimum payment. Payment history is 35% of your score. Automate it and never think about it again. Number 2, check your statement closing dates on every credit card. Log into each card account, find the statement closing date. Set a calendar reminder 2 days before each one. Pay your balance down before that date, not after. This single timing change can improve your utilization score from 30% to under 5% without changing a single spending habit. Number 3, pull your free credit report at annualcreditreport.com. This is the only FDIC-authorized free credit report site. Check for errors, dispute anything incorrect. 1 in 5 Americans has an error on their credit report according to the Federal Trade Commission. Errors cost you points you didn't earn losing. Dispute online, takes 30 minutes, free. That number I mentioned at the start, the $100,000 to $300,000, that's the lifetime interest cost of staying in the borrowing loop the credit score system is designed to keep you in. The average American pays that amount in interest over their lifetime. Now you know the game, now you know the rules, and now you know which rules to play and which ones to ignore. But here's what most people do after understanding credit scores. They focus on debt without understanding what debt actually is, and that misunderstanding costs them more than the credit score ever did. If you don't understand debt, you don't understand wealth. That's the next video.